Everyone, happy Thursday, January 23rd. It's about 10 a.m. on the West Coast, and it's time for another market updates. A relatively light week with data. We do have the Fed's next rate decisions comes up next week, so that'll be a busy week. But kind of nice, not every report came out at once, like it seems like sometimes. But we do have some important housing start and permits data to look at, which is important for future inventory. And then I wanted to take a look at, current U.S. homeowner equity, rent inflation in this country, things like that, which are also very important to keep an eye on. So, getting right into it, like I said, first thing we'll look at December housing starts and permits. This is our first chance to get an idea of future inventory, future homes available in this country. Again, for the month of December, as you can see, permits were down month over month, all across the board. We're down year over year. Starts. So once the home is started, those were actually up 15.8% month over month. But a lot of that came from multifamily at 61.5%. Again, as you can see, all three are down year over year. So not a good sign, for needing, because we do need more inventory in this country. And then completions when the house is done. Those were down across the board year over year. Multifamily is up, so apartments and townhomes and things like that, almost 12%. But single family and overall is down year over year. So again, this is kind of our first chance to get an idea of what future inventory we'll have in about a year. Let's take starts at 1.5 million units. Again, apartments and houses. We lose about 100,000 a year, so let's say 1.4 million. We'll have new 1.4 million units available in about a year. Current household formations. So current household formations is kind of an idea of future demand. That's people moving out of their current household and creating a new household, whether it's a child moving out of their parents' house, a divorce, whatever it may be. New household formed. So that is running about 1.9 million annually. So compared to that 1.4, we're if we needed more inventory, we're operating at a 500,000 unit deficit a year. So if anything, that's just going to get worse as far as our lack of inventory. It's good for current homeowners, not good for because home prices should go up when we don't have enough inventory, and not good for people that are waiting on the sidelines, waiting for prices to drop. So that was an important report to always look at. Next thing, like I said, I want to take a closer look at U.S. housing and rent, starting with rent. Rent's very important. It takes a big part of these inflation reports. Inflation is very important. Fed's really paying close attention to that. So year over year change in rent. Again, we have two different types of rent. You have new rent when you move into a new place, and you have renewal. You already live there and you're renewing your rent. So Realtor.com in December was about negative 1.1% year over year for year over year change in rent. Apartment list is at negative 0.6%, and then Zillow for renewals is showing about plus 3.4%. So the blended, if you add these together, Zillow and Realtor.com is about 1.25. Zillow and apartment list is about 1.5, and then CoreLogic, their October numbers, and they do their own blended is at 1.7. So all kind of in this range. Compare that to the government data, where we get this out of the PCE inflation report and the CPI. CPI in December was plus 4.6% for shelter and 4.3% for rent. And PCE in November was plus 4.8 and plus 4.4. So, over a 3% difference between real-time data, which we're getting from these aggregates, and from the government data that gets reported in these inflation reports. If all of a sudden we just change these out and these inflation numbers were showing real-time data, those inflation reports will come across a lot better. Markets would love it. Fed would love it. But unfortunately, we're using kind of dated, lagging data coming out of these government reports, and that's what the Fed looks at. That's what the markets are reacting to. But we do know eventually this should catch up, and these should start reflecting what's actually going on in the real world. So important to look at because again, that's such a big part of inflation. And the next part I want to look at is, basically the amount of equity U.S. homeowners have in this country. So there's about 136 million households, 45 million rent. They have zero equity, and their landlords have equity, but they don't. And then 91 million people own. They have a combined 37 trillion with a T in equity, and the average per household is over 400,000, 407,000 average amount of equity that a homeowner has in this country. That's a big number. So about out of those 91, 35 million owe free and clear. That's 20 trillion in total equity. They average about 571. So better to have not, and you have more equity if you don't have a loan. But people with mortgages is 56 million, about 17.3 trillion in equity, and they're still over 300, about 311 thousand in average amount of equity across the country. People that have mortgages, so that's great to see. People are in really good shape with their mortgages. Only 1 million people have negative equity, so their loan is more than their house is worth, and that only adds up to about 0.3 trillion in negative equity. So definitely better to be an owner than a renter. That's a lot of equity. It sets you up nice for going on in life. So just something to keep in mind. And then the other thing I want to take a look at is Fannie Mae's Pulsenomics home price expectation survey results for the fourth quarter. The mean number on a $500,000 home was 3.78% appreciation gain. So home prices across the board mean, so average, about 3.78%. That on a $500,000 home is almost $19,000. That's 18,900. 5 years, they have that coming in at 27.16, which would be almost $135,800 dollars in average equity gains over the next 5 years on a $500,000 home. That's a big number. Keep in mind, a lot of these people, talking about waiting for rates to drop. We talked about this before. On a $500,000 home, let's say you put 20% down, so your loan is $400,000. Right now, let's say you got a 7.5% rate. Your $400,000 loan would, your principal and interest payments only would be about $2,800. If you waited a year for, let's say, rates to come down to 6.5%, which is no guarantee, rates could stay exactly where they are or even go up depending on what happens. That principal and interest, if you had a percent lower, would be 25.28. So you're saving $272 a month. That's not a number to that's a good number. That average, that adds up to about 32.64 a year. So a big chunk of money you would save with that 1% less. But that's less than this eight. You would get about $19,000 in equity. So you're leaving about $15,000 on the table in that situation. So just something to keep in mind. Always better to buy now, because then you're the one that's getting this equity over the next year, and that amount of money you might save with the rates may be coming down would be dwarfed by this amount of money in equity in most areas on average. Next thing we got, initial jobless claims came in today at 223,000. Expectations was 220,000. So again, pretty low numbers, but wasn't at least it beat expectations a little bit. Miscellaneous stuff. So tariffs. Nothing really came out with the new administration, President Trump taking office. There was no real strong messages about tariffs in his executive announcements that he came in with. And then he also just today, he was at Davos, I believe, and made some recent comments, or he made some comments on rates. He basically said he will demand interest rates to come down in the United States. Again, he doesn't have control over the Fed. The Fed's independent, but sounds like he's going to put some pressure on the Fed to make rates come down, which I'm all for. But the markets didn't really react, so we will wait and see what happens there. Average 30-year conventional, we're about 7.08. It hasn't updated today, so maybe 7.10, down just a little bit from last week. Important dates, like I said, next week we get the Fed's decision on Wednesday. Then on Friday we get PCE inflation data, and then we get the BLS jobs report on 2/7. Right now the markets have it at a 99.5% chance that the Fed pauses, does not cut. And then just a 0.5% chance that they do cut rates. So it seems, pretty much guaranteed they're not going to cut rates next week. Let's hope the markets don't react negatively, because we already know this. If anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody. Thanks a lot.